Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're going to do another view of velocity banking. Before we do that, I just want to touch upon a trend that I've been seeing. And over the past couple of years, starting from about 2020 or so, I've been seeing a lot of videos about people uploading about how they're leaving Atlanta, right? Maybe they came after 2020 and then they leave after 2, 3 years and they kind of regret coming here, right? This one, Atlanta struggle story. Adios, Atlanta. I quit my job and left Atlanta. Living in Atlanta, why I left. You notice they're all like from the past year or so, right? So a lot of people who come here moving back home. I'm over Atlanta. Yeah, it's time to move on. Officially leaving by Atlanta, Georgia. Just regret coming here. And I'm going to tell you that if you came around 2014, 2015 and just bought any home, I remember homes in prime real estate areas were only going for $200,000. And I was begging my mom and dad, please buy a house here. And they didn't listen to me, right? They didn't listen to me. But it had a different feel back in 2014, 2015 than it does now. And the sad part is, I feel like a lot of Atlanta has basically copied the Los Angeles Hollywood-ish culture. And one of the reasons might be because Hollywood actually does pretty much all of their filming here in the United States. Georgia does give a lot of tax incentives, and I've heard from various people like, oh well, Atlanta has 4 seasons. It's got a bunch of great places to film, natural scenery, all that good stuff. And I think it's attracted a lot of the worst from other states as well, which is quite unfortunate. I was watching this video about how Atlanta is filled with fake, pretentious con artists with professional degrees out to steal your money. And then there was a really interesting comment there where it says, Walter, the reason why so many people lie in Atlanta about their job titles and make it appear as if they are so successful is because interactions in Atlanta and friendships are transactional. Notice the friendships, the quote. And I always thought like this was, like when I think about that, I think about Los Angeles, to be honest, because I feel like we mastered fake transactional relationships. You go there and then, they'll do that probably. I don't know if things have changed, but like from what I remember, people were masters of transactional quote friendships in Los Angeles. When a lot of these folks relocate there, they see that the folks will only entertain them unless they sell themselves with fancy job titles and they come off as if they have money. Unfortunately, this leads to delusions of grandeur and pathological lying, right? And one of the trends that you notice that I think a lot of the complaints that come from leaving Atlanta is that there's a lot of fake rich people, meaning that they pretend to be rich. And here's a funny one. It says, I moved to Atlanta 4 years ago because I thought it was the same ATL from 1993, but all I see is fake people, fake purses, fake jewelry, living fake lives. Now, here's the thing. I'm not going to say this is an Atlanta problem. I think this is just a modern big city problem because, if I went to California in 1993, of course I'm going to like it's going to be a totally different world in California today, right? Like, anybody who goes to California in 1993 is going to fall in love with it. Anybody who goes to California in 2024 is going to think what a mess, right? Same direction I think Atlanta unfortunately is heading, but nobody beats California in terms of fakeness, pretentiousness, people doing dumb things, people being attracted by status, money, and then being taken advantage of and having to leave. I mean, take a look at this. There's this article about UCLA students who live in their cars, and I don't know if you knew this, but I think UCLA is the most applied university in the United States, maybe in the world, right? And in August 3, 2023, most people, like, no, well, not most people, uh, there's a good size of the student population who live in their cars just because it's a place that you can't make it unless you bought a house there in 1980 something. Same thing with Atlanta. You bought a house here in 2014, 2015. Oh my goodness, you're so wealthy. Sky's the limit. You're a young person who thinks you're going to make it in Atlanta in 2021, 2022. You're in the struggle bus, and all you're going to do is meet a lot of fake rich young people who are the same age as you, and then you know, and then upload a video, regret moving here, right? Ton of people like that nowadays. You never saw these videos in 2014, 2015. You never saw it. And here's the thing: if you do live here, and you're making that money, you want to make sure you're not fake rich. You want to make sure that you are actually rich, and it's not a coincidence that a lot of people who are rich pretend to be poor, right? Look at this one. Atlanta is a place where the broke look rich. Do I look broke? I don't know. I'm not a fancy person. Maybe I'm just lying to all of you when I show you this bank statement. I could Photoshop it. Y'all know that, right? And you might be like, "What's your agenda?" Maybe I just want to sell you educational products and what else? Grow my YouTube channel. So I'll post Photoshop doctored bank statements. I mean, it is possible. I mean, you don't know. I could be lying, but then again, am I? That's the thing, right? I've seen videos about this that when you're poor, you kind of have to kind of fake it and make it look like you're rich. And then if you're rich, you don't want people to kind of like always hit you up for money. You're like, oh, no, 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 hey, I saw you got a successful YouTube channel. Oh, man, I just Photoshopped this stuff so that, I can get more views. You know what I'm saying? When in reality, like, you're probably making more than this. I don't know. But sometimes, you gotta do, you gotta do the opposite of where you at so that people don't think like, because there's always a disadvantage to everything. You become poor, people will try to treat you poorly. You become rich, they're always hitting you up for money, right? I got people who are like, well, you make all this money, like I try to teach you how to do that, and you didn't listen, and like, oh man, all right. But here's the thing: when the easiest way to actually feel like you're rich is not like with fancy jewelry, purses, none of that, all the luxury stuff. It's actually just pay off your debts. Pay off your debts. And the more debt that you pay off, the more cash flow you get. And a lot of videos out there too about how $100,000 is enough. But the reason why $100,000 is enough is just people just take on too much debt and they don't know how to manage it. So if you made $135,000, which to most people they're like that's insane, 135,000. How much debt can you really afford? I mean, how much credit cards do you have? Do you got a car loan, student loan? I mean, if you got $94,000, $95,000 of student loans, you better be making some good money. But unfortunately, the government doesn't really care if you make any money or not when you get a student loan. And I actually agree with Dave Ramsey here, where student loan forgiveness is kind of stupid. Just don't give them out. You know what I'm saying? But like these politicians are like, oh my goodness, like we got these student loans are bad, and so we just got to forgive them, but we'll just keep issuing them to the next generation. It's insanity. But okay, so let's actually start a velocity banking review. So what is velocity banking? All it is a debt payoff strategy using a line of credit as your main operating account. Again, that's going to be the main words that we're going to emphasize today. Line of credit, main operating account, and the more debt that we pay off, the more that we increase our cash flow. Okay? Easiest way to feel rich. It's not the luxury bags, it's not the Gucci, it's not buying a BMW. It's when you have money come in and your money isn't being siphoned off and sucked into debt, right? And let's say we do make this good income, right? But the more income you have, the more debt that you can get because banks don't like dealing with poor people. Banks don't lend to poor people, right? I don't know if you knew that or not. That's why because they don't want they're like the pharmaceutical industry. Whereas, like, if you're a big pharma, you don't want to sell medicine to people who are going to die tomorrow because, like, how do you keep the gravy train rolling, right? This is why so many like pharmaceuticals are now targeted toward kids because they want a consumer for life, right? Same thing with McDonald's. They always like try to target kids because they want that gravy train rolling. Like people who are at the end of their lives, they don't really want to deal with that. Same thing with big pharma. Same thing with banks. Like if you're gonna die tomorrow and you're not gonna pay your bills, why do I want to lend to you? Make sense, right? So why am I talking about this? Because a lot of people, for some reason, think that they're gonna be able to get in a lot of debt and they're poor. And the only reason that you can get into a lot of debt when you're poor is because you either lied on your bank application, which is you don't do because that's a federal crime, and number two, you got a loan like a student loan that doesn't require any real underwriting, right? Because the government guarantees it. So any other loan, they'd underwrite you. Even credit cards, they'll be like, you go through an algorithm, and if you write that you're poor, they're just going to deny you, right? So if we make this good money and we have all this debt, and so we have four credit cards, a car loan, student loan, two student loans, we want to figure out how much mortgage we can pay. And if we take a look at Zillow's home affordability calculator, right? I put $135,000 income and I say I have $3,000 of monthly debt. You know how much house Zillow says I can afford? 79 grand, right? So people totally don't understand like how much house they should buy and why so many people are broke just because of overpaying for housing, right? And a lot of people are like, well, I have to buy, and there's always ways to get cheaper housing, right? I bought a $300,000 house, 2 acre farm for 200,000, got $100,000 discount, and I don't even consider myself to be that good of a negotiator. I'm pretty terrible at negotiating. But I don't understand people who don't make that much and they're buying $400,000 homes and wondering why am I broke? Can't do that, right? So let's just say, let's just say, mm, we have 200K mortgage. So technically, according to the bank, you can only afford a $70,000 home if you make a $135,000 income with all this debt. And that makes sense. That makes sense. Now let's just check. How much is that monthly payment? 30 and 30, no, not 30% interest. That's 1199.1. So 1199.1. Okay. So first things first, let's go ahead and calculate a few things. B2 minus B3. All right, so now let me just kind of redo this. So let's just sum up how much debt we have when we're paying it, how much debt we got to pay off. Because when we do velocity banking, the whole point of this is to pay off debt, right? So you got 8 different types of debt, and we want to learn how to pay it off. And so how much? Let's start off with the credit cards first. So 8 plus 15 plus 7 plus 27. That's 50. So the first goal is to pay off 57K of credit card debt, right? And then we'll tackle on the other types of debt. So two things. We assume when we're doing velocity banking, we have the exact same income and we're not going to save any money at all, right? We're not going to save any money at all because velocity banking is essentially putting all your money into debt with the help of a line of credit, okay? And this is the exact opposite of what you're taught in personal mainstream finance classes, right? And we're going to have, instead of savings, we're going to have something called cash flow, which in the very beginning is the same as savings, right? But you're not having any money in your savings account. And what we're going to do from day one is try to increase this number. We're going to try to increase this number on day one. Now, once we've done our budget, we need a line of credit. And so, what is a line of credit? All it is a financial tool where you could borrow money, pay it back, and use it over and over again. That's all a line of credit is, right? And there's credit cards, there's personal lines of credit, there's home equity lines of credit. Let My biggest line of credit is a $50,000 home equity line of credit, and that's because I own a home and I have home equity as collateral. And the bank says, "Hey, we'll give you a tool that's almost like a credit card where you can use it to pay anything." Because you're offering your home equity as collateral, you'll get better interest rates than a credit card. Will give you bigger limits. That's their mindset, right? Anytime you offer collateral to a lender, you get better rates and terms. And people are like, "Well, you could lose your house." Well, you could lose your house by not paying your mortgage. Like, what's the point? Like, why do you? People are strange, right? Like, you do things a little bit different, man. They just complain up the wazoo. All right, so now let's just assume that we have a 10% $60,000 home equity line of credit. And here's the thing that's unrealistic, right? If you're on the struggle bus right now and you have all this debt, there's no way you're going to get a home equity line of credit for the most part. Maybe there's some exceptions, but I'm just saying as a general rule, if you're struggling debt, you're not going to get a home equity line of credit because banks don't lend money to people who need it. They don't, right? They don't lend money to people who need it. So that's why you got to get the credit before you ever need it. And that's how I got over 200 something thousand, 60,000, 70,000. I don't even know anymore. $70,000 in lines of credit because I always got it before I needed it, right? But we'll assume that we have one available. And that's the tricky part because no one wants to build a good foundation before they go off into the world and become an adult. It's always like, let me go ahead and crash the car and then learn how to drive. And it's like, okay, well, don't listen to me. All right, so now let's go ahead and move this credit card debt into, again, we're just doing a simple debt transfer, right? Of 57K, $57,000 of credit card debt. Simple debt transfer, right? These four credit cards, one, two, three, four. And then guess what happens by doing a simple debt transfer? These go to zero. And now we were on the struggle bus, kind of, because 1,500 a month, that's a little bit too risky for me. But now we went to $3,330 in day one without saving, $1,000, or without having any savings and doing the exact opposite of what mainstream finance teaches us. Now, the actual velocity banking strategy, okay, is this: you put your entire $8,000 into this line of credit. The entire 8,000. It's going to do two things. It's going to satisfy the minimum monthly payment and minimize the interest because it's based on the average daily balance, right? 8,000 here, take out the 4,000, and then your cash flow is going to bring down the balance of this by $3,330. Rather than just having savings, in case of emergencies, and then having your money siphoned off by the debt because you're making minimum payments on essentially everything, we're going to apply our entire paycheck until our debts are paid off. Okay, so what we do is we calculate the next month and then next month's balance, and is the previous month's balance was the previous month's interest minus this cash flow number right here, 3334.77, right? And one moment. Okay, so let's calculate the interest using the average daily balance. So we can go ahead and use, sorry, one second. All right, use the average function right here, right? So you can estimate using the average function, multiply it by the interest rate, and then divide by 12. And then now you just got to copy and paste. Copy and paste. And you can see this 57 grand of debt is going to take about a little bit more than a year and a half to pay off. So every time we have a significant debt payoff, we highlight it, we color it in red. And then now, okay, now we got to tackle on the next debt. And so let me just go back here. So that's 19 months to pay off 57K in debt. 19 months, 57K of debt. Okay. Four credit cards. Now we got to take on the car loan, and then let's just put in this car loan right here. So this is going to be originally 24 grand at 5 years, and what was the interest rate? It was 4.5%. And one of the ways that you kind of know if I'm rich or not is that I've never bought a car in my life. I've only had hand-me-downs, so you may want to think about whether I'm rich or not, actually. So definitely do not have a fancy BMW. Although I actually have a friend who has 6 BMWs. I do, and he's rich, and he's the friend who used to take me to Vegas all the time for free to the most exclusive areas, and I just totally like be unappreciative of it. It's kind of sad, but it's what it is. What it is. All right. So 24,000 at 4.5% and 19 months. So let's just go to 19 months, 16 grand. Okay. So currently it's 16 grand. Now, let me ask you this. If you have more loans and debts remaining, how do you know which ones to pay off? And I always like to use the cash flow index, and I'm not going to go over it too much today just because I've been ranting in the very beginning of this video about people pretending to be fake rich, and then you got, if you're rich, you got to pretend to be fake poor. But basically, let me ask you this: would you pay 24 grand to get $400 back, or 45 grand to get $400 back, or 480, right? I would pay 24 grand to get the 440 back, because that's a lot less money to get the 440 back. You get more bang for your buck, which is why I'm attacking the car loan first, right? So one of the things that I can do, and this may not be the most efficient, to be honest, but to help me focus on a debt payoff. And when I say efficient, I may actually be paying maybe a couple hundred more in interest than if I did other methods of paying it off. But let's just put the 16 grand into the line of credit right here. I'm going to put that 16 grand. And simply by moving this 16 grand, guess what happened? This $447 goes away. And now we're almost at $4,000 of cash flow, right? Just by simply moving the debt. And so now what we do is we got to move this we got to replace our cash flow value with $3,782, right? So let's do this. So instead of 3334, it's 3782.2. All right, and then I'm just going to go ahead and copy and paste. And how long does it? Oh my goodness, just only a couple more months. 1, 2, 3, 4, 5, 4 months. Car loan paid off, and now we're at 2 years, so 24 months. And we paid off 57 plus 24. Man, I cannot do math. What's 57 plus 24? 81K of debt. 81K of debt. And then now we tackle on the student loans, the mortgage. So let's just tackle on this one first. So 45,000. And what's the current balance right now? Again, we just plug it into our loan amortization calculator. So 45,000 at 5.5%. So 45,000 at 10 years at 5.5%. And then let me go here, and 45, 5.5, and 45, 5.5 at 24 months. 24 months. Okay. So what is the balance here? So 37 grand. Now, in real life, would I actually do it this way? Probably not, just because maybe you don't have to put your whole loan into the line of credit. You could just attack it into little pieces and it'll be pretty much the same. And I would argue if you put, for the most part, entire loans into lines of credit, you're going to be paying a little bit more interest. But with the mortgage, you really got to be careful about that. I always talk about that the mortgage is, when you pay it off, it provides the least amount of cash flow compared to the amount that you're borrowing, right? And so if you go ahead and replace like a 3% mortgage with a 9% line of credit, you're probably just leaving time and money on the table. All right, so now let's just go ahead and put this student loan right here into this line of credit. And what happens when we do that? Okay, and now we gotta increase our cash flow. So this has been paid off, right? So now our cash flow is $4,070. 4270.57. 4270.57. Okay. So now it's we gotta replace this minus 4270.57. All right. Okay. And let's see how long it takes us to pay that off. 33 months. And then now let's tackle the next loan. So 33 months plus 81 plus 45, 126K. Okay. And then student loan 2, right? Because again, 10-year payoff. And so we got plenty of time to pay this off, but let's focus on that. So 50,000 at 5%. And again, if you're really smart, you wouldn't ever borrow that much money for a student loan, because everybody could just go to community college. You know what I'm saying? All right, so now 50,000 at 5% at 33 months. 33 months. 38. All right. So now 38. Okay, so now let's move this 38 grand into that line of credit. Let's go ahead and do that right here. And now we've increased our cash flow by how much? 530. Okay, not bad. So now we got $4,800 of cash flow. My goodness, 4,800.9. So let's go ahead and replace that number, 4,800.9. Okay. All right. And then in 41 months, okay, we paid off that second student loan. So 41 months. And now it's 176K. You got to add that 50. And now we're at a point where we could just pay off our mortgage easily, right? Again, any two ways to pay off any sort of loan. You just pay cash directly into it. So if it would be this would be in your checking account after every month, and you say, hey, I'm going to dump the $4,800 into a loan. Now, realistically, most people don't do that because when you dump all your money into a loan, can you get it back? And no, because that's why loans have cheaper interest rates than lines of credit, because lines of credit are a two-way street. So you're basically paying more in interest, or at least in the rate, for that two-way access. It doesn't mean if you do it right, you don't have to pay more in total interest. Now, the reason why you may want to move some of this principal into the line of credit is just because you don't have to deal with the hassle, right? Like if I dumped in, the $4,000 into the line of credit and I had some emergencies, then it's going to break your cash flow. And that's why so many people refinance their loans, because, they get a letter from the bank every 5 to 7 years saying, hey, do you want a lower monthly payment? And they'll say, yes, give it to me. And let me take out some of my equity to do, buy a new kitchen or something like that too. So you might want to just kind of move some of this to a line of credit. You don't have to move the whole 200,000 because it's just more efficient to do it in small pieces, right? You could just do it kind of like the same amount as your salary, monthly salary. I don't know if there's a hard and fast rule. I got to figure it out, but I just know that the more you move into that line of credit, the more you're going to pay in interest, right? And it makes sense, right? 6% mortgage, 9% line of credit. They're calculated. The way that the interest is calculated is mostly the same, other than that the mortgage takes the last statement balance, whereas the line of credit takes the average daily balance. But just as long as you have enough cash flow, this interest rate, it kind of matters, but it doesn't, right? And so Luckily, luckily, we have this velocity banking calculator from Renatus, which is where I originally learned velocity banking from. And I know some of you are interested about Renatus because I mention it from time to time. Full disclosure, this whole YouTube channel is just kind of like one of my marketing efforts to market this education, because it's not marketed through the traditional efforts of like, oh, big advertisements and billboards. It's basically word of mouth, right? And so, I spread it through word of mouth. I sell it, get some commission. I don't even get that much commission, to be honest, right? Well, it depends on what I'm selling. So if you enter into like the foundational real estate financial literacy courses, and go ahead and Google it. I mean, you can see the different packages there. Um, if you take that, that's obviously cheaper than the whole shebang, and it's in the company's interest to want, and my interest too, to want to sell the whole shebang, right? Because I get a lot more commission, but you get a lot more education. That's just how how money works, right? The more you pay, the more access to things that you get. All right, so. And full disclosure, again, I do get commission from selling their products, but this is where I learned velocity banking from in 2017. And then, it's so funny that people are just interested in velocity banking, but they don't want to learn things like, oh, understanding credit, oh, finding good deals. So you want to get that, you know, $300,000 home for 200,000 or less, right? I've seen people do get bigger discounts on homes way, a lot better than I have, right? I'm just small, small chump, or what do you call it? Small change in a big pond. I don't know if that's the right phrase, but anyways, let's go ahead and input this information. So this velocity banking calculator just determines our payoff, right? It's 200,000. What's the current balance right now after 41 months of a 30-year mortgage? So let me get rid of this or this. And then this is going to be $200,000. And according to Zillow, I can only afford 30, but luckily, I played it right, paid off my debt quickly, and we'll do 6%. And then now, after 41 months, right? 41 months, where is that right here? It's going to be 190,000, right? 190,000. So 190,000, 6%, 30 years, 1199.1. I think that's the payment. 1199. Okay, good. All right. So $8,000 of income. That's a spicy meatball of income. What's our expenses? It's this $2,000 number right here in general expenses because we don't include the loan. The loan payment is already accounted for here. Now, let me just do this. Well, you might have seen on the internet, oh, always, loans bad, lines of credit good. So always replace your loan with a line of credit. And usually, like I said, there's going to be a huge differential between the loan interest rate versus the line of credit interest rate, just simply because the access to your own money that the banks are charging for it with that two-way street, but the interest is calculated the same. So if I pay this 190,000 or $200,000 and I'm only getting $1,200 of cash flow back, that's not a lot of cash flow, to be honest. This is why we always pay our mortgages off last. And if we go ahead and just replace a loan with a line of credit, we'll just see right here. So 190,964.87, right? Again, we have so much cash flow that we're paying it off in 3.2 years, right? So this is really good, but that's because we have so much cash flow. So you might be like, wow, this is really great, right? But it's kind of like being in second place in debt payoff because what if you could pay off quicker and maybe half the interest, right? So let's just do 10,000, little 10,000 chunks. You see how it was a little bit faster, zero point 0.2 months, but then we basically kind of almost half the interest that we could pay, right? So again, this chunking method where you just kind of like chop it up into pieces into the line of credit and just pay it off incrementally is always more efficient and for the most part, or I won't say always, but for the most part, it's more efficient than replacing a mortgage with the line of credit. Unless the line of credit is the same interest rate in a mortgage, which could be possible if you have an 8% maybe mortgage for investment property and then an 8% home equity line of credit that you got from a credit union. But you're never going to see, oh, you get a 4% HELOC versus a 6% loan. That doesn't exist. Or at least I'm not aware that exists, right? So again, if you have enough cash flow, yeah, it's not going to be a big deal, of 190 whatever, right? And then you see, oh, 32 grand of interest, 3.2 years, but why leave money on the table and why not pay it off a little bit quicker, right? So that's what I'm saying. So 3 years, so 41 divided by 12 plus 3. So all debts paid off, 6.4, we'll say 6.5, 6.42 years, whatever that means. And now, what is our debt payoff? It's you just add $200,000 to this 176, 376K. Bam. We're debt free in 6.42 years, right? So now, instead of being fake rich, where we got to have the fancy stuff, and again, I'm okay with having fancy stuff once you can afford it, but unfortunately, too many people they're masters of this at Korea too, because Korea has kind of like embraced the Hollywood lifestyle where it's like fake it till you make it, which is kind of fortunate. But so many people they want to look successful before they actually become successful, and it's like, yo, just look the part when you actually become the part, right? And then you don't have to be like me and write these fake photoshopped checking summaries or statement balances to kind of increase my views in my YouTube channel. No, I'm just kidding. Do I really do that? I don't know. That's why I don't trust people on the internet. Don't even trust me. This is why you trust the math, right? You do the math and you trust the math, and then if I show you some screenshots, take it with a grain of salt and just say, "Hey, is that real?" And I'll be like, "Nah." Especially when I'm in real life, I'll be like, "Nah, it's just Photoshop, so I could just get more people watching my YouTube channel." and make that sweet, sweet $500 a month in ad revenue. And according to Dave Ramsey, it's funny. According to Dave Ramsey, he was like, what does he say? Like it was like if $600 changes your life, and this was back in 2021, then you're then you were screwed already. And it's like, don't be that insensitive. $400 used to be my rent, but whatever. All right. Well, that's it for today, everybody. Just when you're actually have your debt paid off, maybe you will pretend to be poor like I am in real life. All right. Well, have a great day, everybody, and we will speak next time.